Are the post-pandemic headwinds causing Upstart to change its long-term business strategy? That's the question I'm going to answer in this video, looking at a question and answer session that Upstart held with Wall Street analysts that asked that question, what's your strategy over the next 2 years? Historically, we've had two sources of capital, the CFO says. One source has been the banks that use their technology to lend. They are the originating bank and the lender of record, and they generally use their own money to fund these loans, right? So another source has been credit funds or hedge funds, and they've historically been with us what they call a spot market, like jumping in, jumping out, finding opportune moments to lend money when the rate of return jumps higher and when their credit profile, just trying to time the market. They come in, they go out. They're not reliable sources of funding, and Upstart found that out in the aftermath of the pandemic when interest rates were soaring, the risks of a recession were rising, and these opportunistic lenders were took their money out and they said this is not a time we want to fund any loans, and that left Upstart with a gap between borrowers and lenders because lenders shied away. And so what the management is saying is that our learning over the last 2 years has been that now there needs to be a third source of capital that's more durable. That's more durable, right? That second source of capital has been in and out, and that hasn't worked well for Upstart. And that's partly the reason why, in the last month, Upstart stock is up over 100%. But before that, the stock had been down considerably because the business was experiencing significant headwinds. So part of the learning for Upstart was that we don't function well with that second source of funding being so unreliable. So now they're looking for a third source of capital that is more durable. That is more durable. So the trade-off is for that third source of capital, they're going to offer some preferential economics. So that third source of capital, in exchange for being more reliable, more forward committing, more long lasting, they're going to get preferential treatment. They're going to get a promised higher rate of return and some other beneficial treatments. And I've done a video on that, which I'll link to at the end of this one, that goes into more detail into what that third funding source is getting or the exchange benefit that they're getting. So in general, Upstart says they're happy to share some of the extra benefits in exchange for having a more resilient source of funding because they've noticed that that's a bigger problem. They're willing to exchange a bit of margin, a bit more of the interest rate, a bit more of the interest income with that third source of funding to make the business more reliable, and it won't be so up and down, so choppy, because it's very difficult to manage your business when it's so choppy, when it's so volatile. You can't plan as effectively. You're responding instead of proactively making decisions and making plans. And so Upstart is rightly, in my opinion, choosing this strategy, adapting to this strategy, saying, you know what, let's give up some of the upside in exchange for more reliability, more sustainability in their funding sources. So, longer term, they want to be anywhere from one third of one half of their own capital base. I could imagine is being locked up in long term committed agreements. This part, I'm not a huge fan of Upstart using its own money to fund loans. I'd prefer Upstart just being a platform that provides the technology, the artificial intelligence behind the lending decisions, and bring borrowers and lenders together and take a percentage fee for each one of those transactions. I would prefer that if I was considering investing in Upstart stock or if I was a shareholder in Upstart stock, which I am not. But if I was, that's what I would be more interested in. I don't want Upstart taking capital risk, taking risks with their money in lending the money in in funding these loans because there's a risk they may not get paid back. And I would be more excited in a company that's just a platform bringing together borrowers and lenders. But that's the reality of the situation, and part of that agreement that I mentioned earlier, part of those preferential economics that Upstart had to promise this third source of funding is that Upstart would put more of its own skin in the game. And that is just something they had to do because lenders would feel more comfortable putting their own money on the line if they saw that Upstart was putting its own money on the line. It just makes them feel more reassured in Upstart's decision making criteria in its artificial intelligence models. So that's the reality of it. Although, if going beyond these next 2, 3, 4 years, I would prefer if Upstart would slowly pull back in terms of making its own capital commitments. So to answer the question posed in the beginning of the video, is Upstart changing its long-term strategy? I would say yes, slightly they are. They're adding that third source of funding, that more durable source of funding, the longer lasting source of funding that may reduce Upstart's profit margins, so it might reduce the upside, but it also protects the downside in those volatile times. Its funding sources won't drop as much as it did in the last year. All right, so that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.